Hi, welcome to the Paper Podcast. It's Ryan James. Thank you for tuning in. You know, today is actually March 22nd. Put it in reference since a lot has happened in the banking world in the last several weeks. Everybody I'm sure has gotten their popcorn out and watching all the antics and everything going on. Of course, kind of started and trickled. You have three banks that are no longer here with the start of Silvergate that lost, 80% of the deposits. I did a brief little podcast in regards to Silvergate. They weren't taken over by the federal regulators. They decided to give all their depositors money back and cut their losses and say, we're out. They were a one-trick pony, and that was probably the best thing. Now, I believe they had a ton of monitoring that probably was in the back burner that they, didn't spend enough time investigating on. I mean, they had millions and trillions of dollars going throughout their SIN network through all of the crypto exchanges. So just imagine that volume going in and out. Their AML department, I mean, that should have been where most of their employees reside in, was that, but it was in growth. So they're no longer here. And then now we got, and then Silicon Valley Bank. So everybody's aware of how they were taken under, depositors left. The ironic part is, the people that they've been helping for the last 40 years were the ones that brought them down. So no good deed goes unpunished. But there's a lot. I'm looking forward to this investigation because it seriously does not look like those executives were doing the right thing for the shareholders. You had no chief risk officer in the last 8 months. They got paid outs, last year. You had bonuses paid earlier on. You had the management selling stock several weeks ago. And then they announced, just complete debacle. And then you had Signature Bank directly off of that. Deposits leading, same thing, loss in bonds. And now you've got regulations fighting. You've got both sides now going back and forth. But, it's the ironic here is, to me, there's no new regulations that's going to stop that. They allowed Silicon Valley Bank and Signature Bank to have poor risk management approaches leading up to it. So now they want to come in and do money board quarterback of what they did wrong. But all in all, they've been auditing. The federal regulators have been auditing them at least every 18 months. And so, those practices of having 90% of the uninsured deposits over the 250 limit, that didn't just happen. That's been going on. So I know the scrutiny that we go through in our asset liability management at a small bank. If they went through half the scrutiny that we go through, they wouldn't have been in this position. So, I think there's a completely different, I think they audit smaller banks way differently than bigger banks. And this just shows, because you don't see that risk practices happening in the community banks around the nation. You're just not. We are invested in it. Our money's tied into the future of the bank. Executives at smaller banks have ownership too, just like, they had ownership in stock options. We typically have some ownerships in the bank too, but it's not weighted as much as it over there. We take every decision very carefully, and, community banks, I'm sorry, we're not Wall Street greed like what you're seeing there. But then the amazing thing is, the rising rates definitely cause this. You increase the rates, the bond values are going to go down. You keep rising rates, those bond values are going to go, and they're going to have unrealized losses. But what the average consumers don't understand too is accounting principles. We have to recognize the associated losses on the bonds. But are you seeing that in loans? If you set loan prices, they're still at principal value. If you were to go liquidate, and that's why you're seeing the sale of the assets, loans are also locked in at rates prior to this rate hike, majority of the balances. So, loans aren't marked to market. Maybe we need to also look at the accounting rules when it becomes held for available sale, hold to maturity, because that gave then the impression that Silicon Valley and Signature Bank were immediately going, and so depositors just fled. And then what did the regulators do? Well, they came in, hey, we're going to come in here and we're going to ensure all the deposits. I have mixed feelings about that. You know, you allowed them to get to that point. Now you're coming in and, you know, covering all the deposits. Well, who's going to pay the insurance fund? It's going to be all the banks that had great risk management practices. We're going to be paying special assessments later on. But then again, I do believe by them doing that did slow down and allow businesses to, you know, have comfort in their banks. So, you know, it's a double-edged sword. But then they said, oh, well, we're not guaranteeing we're covering any banks. So what happened? You had a lot of depositors that were then going to the largest banks because they feel like, hey, well, the top 4 banks, they're going to be too big to fail. So if they did fail, all of our deposits are going to be insured. So it'll be really interesting to see the migration of the overall deposits nation. You know, my theory is the top larger banks are going to get larger. Now, in talking to other community bank colleagues, they have not had any losses in deposits because they have good risk management practices. They speak to their customers, their clients, and, you know, there's faith all around, you know, we hands-on approach. So that is fantastic, and we need to continue to grow community and regional banks. We can't allow the banks to be $200 billion in assets and have such piss poor risk management approaches. So, you know, that's kind of my feeling on that. Don't see enough of, it's hard to tell exactly on Signature Bank what they were on that day when they came in and take it over. Clearly they saw deposits were running and there was losses and they had to come in. So, I mean, they came in pretty fast. It was pretty impressive how quick the feds came in. Now they're coming back and yelling and saying, hey, we'll cover all the deposits. You know, I think they realized that they made a mistake by saying we're just covering the big banks, and then you had an outcry, but now they're covering all the deposits. Now, is that kind of, you know, okay, well, you know, the first thing was on page 1. I'm sure that's, you know, page 6. So I don't think that got out to the, you know, the consumers in the business world, like saying we're only covering, you know, case-by-case basis. So they need to do a better job of pushing that out there that, yes, all the deposits are going to be insured at this time. So, you know, guys, get ready. It's going to be, you know, interesting year. But all in all, you know, the regulators, they allow poor risk management practices, now going to come in and say, hey, you should have done this. And now you're going to have Congress and senators saying that, you know, we need to enact more things. Well, if they actually just held all banks to the same standard, you know, these are going to that particular issue is not going to happen. They allowed the balance sheet to completely get unweighted in their maturities, and they had too much weight in one center. It's good to have niches, but you have to diversify within your niches as well. And, you know, I can tell you the historical decay rates and everything we do quarterly, and go through that and look where we're, you know, I have to assume a $200 billion bank should have been going through those, but, you know, apparently, you know, they didn't spend enough time on it, or, you know, maybe they passed, you know, their amazing, graphs and form, and their regulators bought it during the last, examination cycle. Who knows truly what they, did in the risk management practices, but it'll be interesting to find out. If you like what you hear, please comment. What do you think on, you know, what's going to happen in the situation? Are we going to get more regulations coming in the banking world? Are they just going to actually now punish banks that are doing well? You know, I think the examiners are going to come in again. You know, after 2009, what we were seeing is examiners coming in and, you know, they were told by higher ups, you missed this. And so then they were harder than they should be in other areas. And now, you know, what's going to happen is shit's going to fall downhill, and community banks across the nation are probably going to get the extra brunt of this. Another mess that we did not create, nor were we going to create. And I'm sure there's going to be extra scrutiny on us, but, you know, bring it on. We're strong. We have resilience. We don't have poor risk management practices like they clearly did. So let's see what happens. But please like, subscribe, and let me know your thoughts. Thank you.